welcome to this month's ATV Tax Tips. This month we're going to be addressing a question that we get asked quite regularly, which is, can I pay the school fees for my children through my limited company? Now, if you were to pay the school fees for your own children as a director or employee of a limited company, then unfortunately you'll be subject to income tax and national insurance on those payments in the same way as you would be if you were drawing the money out as dividends or as salary. So where you're a parent looking to meet school fees for your immediate children, the answer is there isn't really any benefit to doing it directly from the company because it's just going to cost you as much tax as it would if you drew the money out in any normal way. Now, that's not the end of the story, because there are possibilities to implement some tax planning that could allow individuals to meet school fees for children using a trust structure. Now, what would happen is trust would receive some shares from that individual. They would gift the shares to the trust. The trust would then, having ownership over those shares, be able to receive dividend income. And if the children who are currently in private education are beneficiaries of the trust, then the trust can be directed to meet the school fees of those children and potentially save everybody involved a great deal of income tax. So, who can do this sort of planning? Well, as I mentioned, if parents try to implement this planning, then what's called the settlements legislation applies, and it prevents parents from undertaking the planning because it states that where income that arises under settlement is paid or made available to the minor child of the settlor, then the settlements legislation will treat the income as the income of the settlor, which means that effectively if you placed your own shares into a trust and use that trust to meet the school fees of your immediate children, you will be taxed on that income in the same way as I described first of all if the company simply paid the fees directly. However, that settlements legislation only applies to parents and their immediate children. It does not apply to grandparents and their grandchildren. So if grandparents are still involved in the running of a limited company, or even not particularly involved in the running of it but have shares in the limited company, then they can undertake this planning potentially for their grandchildren. Some initial considerations that grandparents would need to make in this instance. First of all, what sort of trust should we be using? There's various different sorts of trusts, and it's important to consider not just the immediate use of the trust, i.e. potentially to meet private school fees, but some fairly longer term considerations such as will the trust continue to meet university fees, and will it be used further down the line to pass wealth in the future to those children, perhaps as part of wider inheritance tax and estate planning as the grandparents grow older and older into their old age. There also needs to be a consideration on the impact of the income of the grandparents. At present, it might be that grandparents are in business with the parents of the children, i.e. the grandparents' children, who are adults now, and they're running a family business together. The grandparents may be reliant on the dividend income at the moment for their own lifestyle and to meet their own income needs, and they may not be picking up the tab for the private education at the moment. It might be that their children, who are the parents of the grandchildren, are meeting those school fees, and so we need to consider carefully the position of all family members and ensure that nobody inadvertently reduces their income to a point where they struggle to meet their day-to-day living requirements. So, as I mentioned before, the mechanics of the planning are relatively straightforward, but the complexities come at each stage in considering all the relevant taxes. So, a trust would be established, and the grandparent or grandparents involved would be the settlors of the trust, i.e. they will be the people who create the trust. And the grandparents will be looking to transfer shares in the limited company that they currently own. They will be looking to transfer a proportion of those shares into the trust. Now, transferring any asset into a trust needs careful planning. There's inheritance tax consequences and capital gains tax consequences that need to be considered on any asset transfer, such as these shares. And we need to understand whether any capital gains tax or inheritance tax may arise before we do the planning, because if it does, it may negate some of the benefit and actually make it not really worth doing. There are generally planning areas that can be met in order to avoid these taxes, but it does need careful consideration. Now, once the trust is set up and it has the shares, then it starts to receive the dividend income from the limited company. And once it receives that dividend income, it has to pay income tax on it in the same way as an individual does. But the beneficiaries of the trust are the minor children, the grandchildren of the settlors, and usually they wouldn't have any other income themselves, and therefore they have their tax-free personal allowances available. So each beneficiary, each child, can receive up to £12,500 a year without paying any income tax at all. And if that's the case, the trust is able to reclaim, the trust pays the income tax, and then the grandchildren are able to reclaim the income tax paid, thus making the dividend income effectively tax-free in their hands. Once the trust has received the income from the dividends, it can use it to pay the school fees on an ongoing basis. And because it's tax-free, we're looking to save a huge amount of income tax here. So talking about these savings, let's consider a child roughly age 7, about to embark on their private school education career. They're going to be at school for the next 10 years until they've completed their A-levels. Let's take some average private school fees. They're going to be in the region of £10,000 a year. So if the grandparents are currently higher rate taxpayers, they're normally paying 33.5% on their dividends from the 6th of April this year. Anyway, that's what the new income tax rate will be. So the tax saved could be £3,350 a year, because that income that's normally subject to higher rates of tax in the hand of the grandparent will suddenly become subject to no income tax in the hands of the beneficiaries of the trust, because it's falling within their tax-free personal allowance. Now, £3,350 a year tax saved over the next 10 years for one child is going to amount to a total tax saving of £33,500. And of course, if there's more than one child, then we can multiply that £33,500 saving by the number of children. Very easy to get to a saving. If you've got 3 children, you could be saving around £100,000 in income tax. So well worth considering. If there's any grandparents out there with grandchildren who are looking to start private education, or indeed if they're already in private education, it's something you can put in place for children, even if they don't have to be just starting. They could be in the mid-teens, halfway through their private education. It's still very well worth considering. Okay, this month's Ascentis Quick Tax Tip is all about director salaries for 2022-23. We've just started the new income tax year, and in the spring statement, I'm sure many of you will see that the Chancellor decided to increase the employee national insurance threshold, and he announced that it will be coming into line with a tax-free personal allowance. And at face value, it sounds like we should all therefore be paying director salaries of £12,500 a year. But that's not quite the case. First of all, if you're a sole director, you're just the only person on the payroll, and you're looking to keep your administrative affairs as simple as possible, then actually you should be paying yourself a director salary of £9,096 a year, or £758 a month. Now, the reason for that is that whilst the employee threshold for national insurance has been increased, the employer threshold has not. And if you're a sole director, you don't qualify for the employment allowance, and so anything above £758 a year will attract employers' national insurance, and you'll find yourself having to make a very modest but administratively cumbersome contribution to HMRC every month to meet your employer's national insurance liabilities. Now, if you're a director with other staff on the payroll and you are meeting PAYE payments on a regular basis, the most tax efficient salary for you is £11,908 a year, or £992.33 a month. At that level, you're going to attract some employers' national insurance, but the corporation tax saving that you get alongside that offsets it, and so it's worth increasing your salary to this level. It provides the optimal tax saving. The reason we're not paying at £12,050 a year is not just because of the employer's national insurance, because as I said, for directors where they've got a payroll, the saving is offset by corporation tax. The reason we're not going to £12,050 is that whilst the Chancellor has looked to align the two rates, the employee national insurance threshold and the tax-free personal allowance, the change doesn't take effect until the 6th of July this year, and so there is a lag in bringing the employee national insurance allowance up to the tax-free personal allowance threshold. And so if you pay any more than £11,908, you will incur employee national insurance this year.